Konnichiwa. Welcome to this week's edition. We'll talk about the UAE market news, and our preferred stock for this week is Aramex. UAE markets have stabilised this week, with the DFM hovering around 1,810 points and the ADX index hovering around 2,760 points, both of them buoyed by a strong oil price around $65 per barrel. Company reporting has dominated the news in the UAE this week, and we've had some across the board reasonable quarterly results. National Bank of Abu Dhabi, NBAD, reported second quarter results this week. The result was strong. NPAT rose 17% to 907 million dirhams. So quarter on quarter, the bank's earnings and revenue are growing strongly. Provisions have increased to 500 million during the first half of 2009. This is in line with other UAE banking peers. NBAD's diversified earnings stream continue to hold it in good stead. The bank earns revenue from corporate banking, investment banking, retail banking, and also treasury banking, which is one of the reasons why we think it is a strong bank to buy. Capital adequacy remains strong at 17.9%, and the bank has a low cost to income ratio around 28%, second only to First Gulf Bank in the UAE. Annualising the earnings per share gives us a price to earnings ratio looking forward of 8 times, so the bank represents strong value on PE multiples. We continue to rate First Gulf Bank an overweight recommendation due to the fact that it has strong government ties, return on equity above 20%, an attractive risk profile, and a diversified earnings stream. In addition, NBAD has announced that it will conduct a share buyback program equivalent to 10% of its shares. We believe that this will continue to act as a share price catalyst and support earnings per share growth going forward. The banking sector, First Gulf Bank, FGB, reported second quarter NPAT this week. It declined by 4% year on year to 775 million dirhams. There were strong contributions from each of the treasury, corporate and retail divisions. Net interest margin actually improved during the second quarter to 3.7%, and the cost to income ratio is the lowest of all of the UAE banks, hovering at around 21%. 260 million worth of provisions were taken during the second quarter, including exposure to the Saudi groups Saad and Al Ghassabi. During the same period, deposits increased by 13% while loans decreased by 8.4%, improving the loans to deposits ratio to 103%, which is below the UAE average of 110%, indicating that the bank's risk profile is lower than other banks in the UAE. FGB remains our top banking pick along with NBAD. The bank has a favourable retail funding structure comprising high percentage of retail client deposits, also less reliance on wholesale funding. We have a target price of 18.14 per share versus the last close of 16.50, implying strong upside. In the property sector, Abu Dhabi property giant Aldar reported second quarter net profit down 79% year on year and below our expectations. Net profit was 251 million, although we do not know the component of this from revaluations and the component from actual cash flow items. We had expected the profit to be higher based on the fact that Aldar has a large amount of legacy sales yet to come through the profit and loss statement. The outlook for second half 2009 remains cautious on Aldar, with turnover and prices stabilising in Abu Dhabi, where the bulk of Aldar's projects are, but still well down on the turnover from this time last year. We expect a trickle of sales to come through from some of Aldar's projects in Abu Dhabi, including Al Raha Gardens, Al Raha Beach, Arbraj Towers and the Al Falah project over the next 12 to 18 months. We still retain an overweight recommendation on Aldar and believe that because of its high-grade project pipeline, its strong government ties and exposure to the long-term growth of Abu Dhabi under the 2030 program, that the stock is a strong investment long-term. Our 12-month price target is 5.71 dirhams versus the last close of 4 dirhams. In other news, local property consultant ProLeads has stated that there are 300 billion US worth of projects currently on hold in the UAE and 280 billion worth of property and infrastructure projects currently in development in the UAE. This highlights that although the property cycle has slowed down, there still remains a strong pipeline of projects in core areas of the economy that are still ongoing. And therefore we expect this to flow through and continue to support property earnings and construction earnings over the next 12 to 18 months, although this is a lot slower than what was happening in 2008. Shipping company Gulf Navigation, listed on the DFM exchange, has appointed a new CFO this week that brings 30 years of experience in shipping and bulk chemical transportation to the company. Gulf Navigation is beginning to look attractive on our investment parameters. The company is set to benefit from a rebound in world trade. As a leading indicator to this, the Baltic Dry Index has rallied strongly in recent months, and Gulf Navigation trades on attractive price to earnings and price to book multiples, with a large cash balance on its balance sheet, and also 7 out of 19 tankers contracted on favourable long-term forward rates to SABIC, a key client in the region. This week's key stock is Aramex, listed on the DFM. Aramex is a logistics and delivery company operating across the world with offices in 200 cities. The bulk of revenues still come from the Middle East, around 65%. However, the company has been able to grow its business in Europe, the US and Asia. Aramex has built an asset-light business model revolving around strong margins and high turnover without infrastructure ownership. The Middle East operations has provided the cash flow for which the company has been able to expand in other markets. Looking forward, we expect a greater contribution from markets outside of the Middle East during 2009 and 2010. Aramex is the number 2 player around the Middle East region and has a very strong market position, which has allowed it to withstand the pressure on earnings during the current economic crisis. The nature of the parcel and logistics and delivery industry holds very defensive characteristics. At a time when the business cycle contracts, Aramex has been able to negotiate cheaper transport rates with the shipping and air freight companies which it partners with. Therefore, margins improved during the first quarter, and the company was actually able to increase its net profit by 25% at a time when revenue decreased. We expect this trend to continue in the second quarter result, and that it will be released around expectations and very positive, implying strong share price upside. With a low gearing ratio below 4%, strong cash flow generation and this excellent market position, we believe that Aramex is increasingly likely to acquire smaller competitors in this logistics and delivery market over the coming 12 months. The company is aggressively looking to expand into China and also through franchises in Africa and other parts of Asia, meaning that earnings from abroad will increase over the next 12 months. The upcoming price catalysts are likely to be a growing share of earnings offshore, ongoing earnings growth into the second quarter and putting out a good result, and also potentially ongoing acquisitions and partnerships overseas. Aramex last traded at 1.6, and we believe that long term there is excellent upside in the share price, and therefore it remains one of our preferred picks in the UAE markets. That's all for this week. Happy investing. Domo arigato and sayonara.